All right, fasten your seatbelts. I'm an allocator. I think there's still a few allocators left in the audience. How often have you had any yourselves asked you these questions, or any investors you have said, okay, here's what I want from you. I want a compelling yield now. I want protection from the unexpected, whether that's rising rates or declining rates or bad times. Liquidity, low correlation, it's got to be a complement to everything else in my portfolio. And oh, by the way, I need cash income while I'm waiting for good things to happen, and it's got to have quality controls, and gee, I'm not that smart, it's got to be simple. Did I leave anything off? I don't see any hands. Okay. Some investors said to us, and I said to myself, geez, I feel like Don Quixote. Is it an impossible dream? Can you actually get those criteria in an investment in today's climate? I think you can. We got that question asked of us, and I sort of went around in a circle with one foot nailed to the ground, and I didn't get it for a long time. Eventually, the light bulb went off, and I said, you know, just maybe, could we be investors such that we earn the spread that bankers traditionally have gotten? Because I submit to you all, that's the alternative lending story, right there. Now, being a chicken, which I am at heart, I said I would never do that unless I could create a diversified portfolio, multi-strategy, and you'll hear this prejudice interwoven. I want multiple domain experts playing in the different spaces. Okay. Here was the model portfolio, and Mark Salome, when he said, Snyder, you want to talk to this group? I said, okay. He said, make it a generic presentation on the space. Okay, here's what we did. We did exactly that. You can get today returns of 8 to 10% by doing this, an average duration of 2 years or less, nicely protecting you against rising interest rates, if they actually ever do. Extraordinary downside protection. This portfolio has about a 2-point default rate. And then you'd say, well, Alan, business conditions today are pretty benign. It's true. But you can have an 800% buffer for default rates to go up 800%. A lot of protection on the downside. To me, Mark didn't mention I got tagged years ago. I moved out to LA to get my head handed to me to restructure California's largest insurance company called Executive Life. I see a few people that might remember that company. It had cornered the junk bond market, $18 billion in junk bonds and $2 billion in now affectionately called alternatives. All right. The junk bond argument, high yield bonds, the argument's always been, gee, the rates are high enough to cover defaults, increasing defaults. And by and large, it's been true. Except high yield bonds have a longer duration than this, have market sentiment as a risk, and maybe these rates are so much higher, which you've heard pieces about in the two very good panels earlier. I submit to you, you can get quarterly liquidity. These guys were just recently here, they're direct lending. I would say that's a slightly different space than certainly like Echelon, Steve Diamond was talking about, and some of the others. I would call those alternative lenders. You can get multi-asset diversification. I have zeroed in on 5 segments, which I'll talk about. Here's the assertion I made, and I want you to, anybody who feels otherwise, we can have some fun in the discussion. I submit to you that portfolio on a risk-adjusted basis is better than any other yield-generating asset I know of in the world today. Just quickly, a traipse through the tulips. High-yield bonds. Ooh, bad year. Bad year. Liquidity? Yeah, maybe. Yield? Not as good. Dividend stocks? Ooh, equity risk. REITs gotten creamed in the last year. MLPs, well, I think everybody in this room knows that story. High yield. Do you want to catch a falling knife right now? Closed-end bond funds. Barron's loves closed-end bond funds, right? They're always talking about them. Well, you can buy those bonds at a discount. They're longer duration, and just maybe that discount will widen. It is a risk, I think. BDCs. Ooh, high yield. It's an equity security. Anybody here own BDCs in the last year? It's been painful. The equities went down sharply. SBA loans, pretty good, less liquidity. Yieldcos, oh my goodness, nobody read the covenants. Took a lot more capital than anybody really talked about, so they haven't worked out so very well. And of course, traditionally in these settings, there's always a lot of people that have made a fortune in real estate. Income property, good. Almost all of these things belong in a portfolio somewhere, but I submit to you today and going forward, they're not as attractive as the alternative lending space. Okay. I'm going to try to backfill and skip over some stuff that weren't covered earlier. The non-bank bank space is a $51 trillion market globally. Gentleman asked, he left, darn. He asked about China. China's the biggest. He didn't get a complete answer. It's the biggest space. The problem I have in playing in China is with alternative lenders there, they drop like flies. The regulatory environment is pretty casual. So you'd best be ultra careful. But it is the largest market for this type of lending. Traditional lenders, I'm going to try to summarize what was talked about. Having played with traditional bankers, traditional banking I'm defining as those that take deposits, bureaucracies. Those branches cost about 30%. It's one of the reasons alternative lenders are so much more cost effective. The technology is dated. Years ago, my swan song on real estate was working with two other people and starting the Discover card. Even then, you could buy the credit scoring models. Big data has arrived. The banks, traditionally, their models are dated. They have not been as refreshed as some of these alternative players. And the banks obviously are getting re-regulated, and many of them need to repair their balance sheets. One other phenomenon that wasn't talked about, which is also equally real, community banks, which have lent in this space, have also gotten hammered with Dodd-Frank. Since 2010, there's been one community bank formed, just one, and incredible consolidation. I was talking to a guy running a community bank. He runs a bank with $2 billion. He said, Alan, we're screwed. We can't originate loans. We're too bloody small. That's the problem, I would argue, and I'll give you some statistics in a minute. Alternative lenders, they don't accept deposits. Takes them out from some of the regulatory morass. To really simplify it, what are they doing? They're acting as intermediaries between investors and borrowers. They're a conduit, by and large, in various flavors. They enjoy a truly substantial cost advantage, so they're not going to blow away. And I'm going to come back to, I think the banks, there's a question asked, well, Alan, what if the banks decide to get serious and re-enter the space? I don't believe it. I don't believe it. They can't change their bureaucracies easily. And in my prejudice, I want to invest like some of you, in people that bring specialized expertise to their own niches. You've heard some today, there are many more out there. Give me the specialist that's eating, living, and breathing the space they're playing in. The new guys, what are they doing? They're not always so new either. They're just getting written about. The new guys are really the platform lenders, and I'm going to talk about those too. What do they have? They have the ability to start with a clean slate and get incredible technology. Big data has arrived in the space, and that gives them an edge. So in my checkered past, I started a insurance platform, web-based company. We had an advantage. Eventually, and it took too damn long, we became the largest seller of auto and home insurance in the United States as a non-carrier. Why? Because our customer acquisition costs were lower than the Progressives, the AIGs, the Hartfords, etc. Because we could use the web and it was cheaper to get customers. That's true for a number of these players, not all. Jamie Dimon, of far greater fame than me, gave a speech and he said, you know, to the bankers, he said, Silicon Valley is coming. And then he said, even harsher, he said to these traditional bankers, he said, they're going to eat our lunch if we're not careful. Now, it was talked about very fleetingly, and this is why I say banks aren't going to casually get back into this space. Jamie Dimon, generally regarded as one of the best traditional bankers out there, has said, I can't change my organization fast enough. He's partnering with some of these new platforms, Avant, which wasn't talked about, On Deck, and others. RBC's doing the same. A lot of the traditional banks are partnering with these platforms because they can't change fast enough. So I don't think directly they'll enter it. Now, if they play with the platforms for us as investors, that's good. There's a lot of neat stuff here. I'm going to go through it pretty quickly. Goldman Sachs, in the last year, all of these, by the way, all these research reports have come out in the last year. Goldman Sachs calls this space the future of finance. Morgan Stanley, my old firm, forecasts a 51% compound annual growth rate in this space through 2020. Harvard Business School, geez, haven't been tortured there personally. I'm prejudiced. They came out with probably, I think, one of the best reports. If you haven't snagged it, ask me and we'll send you some of these reports if you'd like them. They gave a very deep analysis about small business lending. They are saying the banks can't compete. Some of the players in different ways said the same thing. I'll give you a fact, though. The delta from 2014 to 2015, banks decreased their lending 38% to small businesses. And you're right, as the earlier panels talked about, their definition of small business is pretty big. And they're continuing, by the way, the more recent data continues that trend. McKinsey wrote about it. Towers Watson, if you haven't seen it, it's a very interesting report. They talk, and maybe it just resonated with me, they talk about how you should play in this space. They say, do not invest in a single alternative lender. They think that's risky, and they go through a fair amount of mathematical analysis as to why. They say the only way to do it, if you want to do it yourselves or go to somebody else, is to have a multi-strategy, multi-expert execution. Say far safer will give you a better, diversified, more return. Credit Suisse went through and said, look, fintech is real. It's happening, and it's going to continue to happen because of big data. and all of the utilization of web executions, et cetera. Moody's weighed in, the Wall Street Journal, and here's one that's a little bit of a reach, but maybe having been in the insurance business, I still think is extremely attractive, a little controversial. Life settlements. How many people are familiar with life settlements? A bunch. 20 years ago, I would never have touched it. Today, it's different. Today, 20 years ago, you had a lot of guys enter it, quick buck, super leverage. The analysis, the actuarial analysis, you could have put in a thimble that were being applied to it. Today, it's serious. The biggest players in that space are Berkshire Hathaway. Thank you, Warren. AIG, a multi-billion-dollar portfolio. CalPERS, from California. CalPERS is a big investor. Fortress, Apollo. They're at the top end. At the bottom end, a little scary. At the bottom end, you have insurance agents selling fractionalization of policies. Don't do it, please. High risk. You need the laws of large data. Mathematically, you need to invest in a portfolio that has a minimum of 250 policies or more. In the middle space, there's become institutional grade in places to invest. The ones that I particularly like have 70 million of their own money in. They manage about 450 million, no leverage. They use a third-party actuarial firm to evaluate the portfolio monthly. Pretty neat. And oh, by the way, you want to be sure you can pay the premiums, which is why the highly levered players got crushed. These guys have an 18-month line of credit. If nothing happens, if nobody dies, not likely, they have about 1,000 policies, and no new capital flows in, they can continue to pay the premiums and remain them in force to collect those death benefits. In their case, they have an average portfolio of 85-year-old people, giving it a 5.5-year duration. Pretty attractive. Conning, this came up recently, in fact, a day ago. People said, yeah, Alan, but maybe there's too much capital in that space. Conning, which is probably the most famous insurance analytical firm, research firm, says, Conning says about, as you can see up here, I think it's up there, 180 million, it'll be up billion, is going to be available for purchase as baby boomers retire. In fact, they estimate $2 to $3 billion is looking for a home every year. They think there's too little capital in that space. For us allocators in the room, that's a good thing, right? You don't want too much capital flowing in. All right. To give you some other hardcore information, Goldman Sachs says in the US it's a $12 trillion market. So it's big. They estimate that in the next 18 months, think about this for us. We want to be the investors, right? We want to earn the profits that the banks had been earning. They estimate that $1.6 trillion is going to migrate from banks to these alternative lenders. The banks have made, which they were doing it from a security perspective on the banks, evaluation, that's going to be $11 billion of potential profits or more for investors in this space. Global trade finance, which I think is pretty neat, $18 billion, and Conning I already talked about. Okay. When you think about this, what are the trade-offs? Here's the killer. Everybody's going to do it differently. We did it a specific way for this model portfolio. You're going to decide what's your appetite to do the trade-offs between yield, how much leverage, if any, do you want, duration. We opted for pretty good yield, low leverage, short duration. What collateral do you want? What's your liquidity requirement? And correlation. We wanted low correlation. So the strategies, you're going to say, hey, which strategies? I'm going to go through them in a minute, some alternatives to stimulate your own thinking as to how you want to do it. The last item on the right-hand side, loan selection. Here's my prejudice. I want a domain expert picking the loans. Some investors say, no, I'm going to select the loans myself. Okay. Do you have the expertise to do that? Or do you want to delegate that, in effect, to a domain expert? Okay, let's go through a little bit more detail on the different possible places. Consumer lending. You heard a bunch of consumer lending platforms up here earlier. Great, I'm going to get to some risks that didn't come up yet today with the consumer lending platforms. Good space. Primarily, it's equivalent to credit card debt. There's about $1 trillion of credit card debt outstanding. People say, Alan, but there's so many players entering that space. Oh my God, maybe I should sit out. The current players, I don't think that's a good answer. The current players have a 1% share of the market. Now, maybe if they were 10 or 15, I might worry about it, but a 1% share, I don't think it's a terrible risk. And by the way, as Colin talked about, credit card debt has performed in almost every market environment, economic climate. That's why the banks have loved having credit cards and generating huge loan balances in credit card debt. But consumer lending goes beyond that. I'm just going to tickle your fancy with one example. You can have, and there are players out there that you can search out and find, that make collateralized loans to consumers. Let me give you one fun one. In the great state of Texas, there's no income taxes, pretty neat. But there's high property taxes. So if you're short and paying your property taxes in Texas, you can borrow the money. And we found a player that lends the money. Here's the neat thing. You're talking about a 14% loan-to-value ratio. And in that state, as the lender, you are senior to the first mortgage. Now we're talking security, and the rates are extremely attractive. Now you're talking about a loan of somewhere between a year, maybe an average 1.5-year duration. I could go on, but I don't have the time. Business. You heard some of the people talking about business platforms. They're real, they're growing, they don't have much share, lots of room to grow. But that's not the only place. You can get shorter duration business loans. Let me give you some examples, just to pique your curiosity and to encourage your pursuit of this area. How about hard asset lending? Hard asset lending, 1-year duration. This is basically where you put up your firstborn as collateral. If you burp, there's another fee, so the rates are very high. Is that so bad for the business? No, it allows them to continue to grow. Okay, one type. Second type, you heard, I'll give you a slightly different version than the guys just up here before. Another version is lending to small public companies, lower rates, call it 8 to 12. It's almost like a carry trade. And you're getting equity pieces, warrants, conversion rights, restricted stock to give you in higher returns. And again, fairly short duration. All different flavors of lending like that. So you don't have to just focus on the lending platforms. Trade finance. All right, in a portfolio for the chicken up here, Trade finance, is moving a cargo of grain from Brazil to China. Now, if the off-taker in China doesn't pay up, you can hedge that with futures. It's basically about a 50% loan-to-value ratio, pretty good. Clearly a fungible trade if something went south. If the boat sinks, maybe it's eureka because you got it insured. That's one flavor. Another flavor is lending against receivables where the crop is in a bonded warehouse. Ooh, high control. Probably about a 60%, 65% loan-to-value ratio safer. Now, the problem with trade finance is the yield is 6 to 9%, so it's a lower yield, but the duration is 3 to 6 months. Very short. Life settlements, pretty neat. The rate you can get on is somewhere, depending on the year and the death pattern in that particular year or the player, you can get somewhere between 10 and actually 15% plus. And I know this, you'll hate this, there's clearly no correlation to anything else in your portfolio. Almost the same is true for trade finance. Now here's a controversial one. No student loans in this model portfolio. All right, we've all heard about SoFi and some of the other student loan lenders. Here's my prejudice. I don't like it. Because, and I'm not arguing social policy here, you've got an administration currently, maybe it'll be even more so in the future, basically saying to all the student borrowers, gee, we're going to do everything in our power so you don't have to pay those loans back. You're seeing student default rates go through the roof. Now, SoFi has pretty tough underwriting, only to the best schools with the best blah, blah, blahs, but I don't want to fight the social trend. Okay. This model portfolio, here's the balance. And our prejudices were confirmed by some of the research. We said a higher skew into business, small business loans. Why? The collateral's better. Real estate, not too big. Life settlements, reasonable allocation. Trade finance, a little lighter because it's so short duration, the yields are less. And the consumer, a blend of secured and unsecured lending. Okay. We're all steely-eyed in our evaluation of different managers, right? We kick the tires, we get third-party players to research them, all good stuff. The managers that I picked for this portfolio manage about total $2 billion. So it gives them an average AUM of about $200 million. Smaller. We all read the Imperial College, the City College of London, PerTrack, et cetera, the research saying smaller managers generally outperform larger, and here's the shocker, they generally have lower risk for the best ones. Takes a lot of homework, though, to find them all. So that gives you a sense of what's available to find. I got to dwell on this for at least 90 seconds. Here's what I did on this portfolio. I said, all right, it's generic. Let's take the underlying allocations and do a stress test. Let's really put the hammer down. So we took the gross yield of each of these different allocations, subtracted out the operating costs of the manager and the manager fees. They wouldn't earn incentive fees in a stress test. How much money was available to pay for defaults? In this portfolio, it has about a 1.6% default rate. You have almost 13% buffer before you'd have a principal loss, assuming the losses were evenly distributed. Okay. to satisfy ourselves in evaluating this space, mostly me, I'm the largest investor in Shinnecock. I said, well, how does that 13% compare to what the market has? What happened in '08? I'll give you the specifics. It was alluded to, but I'll give you the actual numbers. Lending Club, their loan cohort for 2008 generated a 3% cumulative compound return. I don't know about you all, but that would have been the least of our worries, I think, in '08. In '09, their loan cohort for '09 generated 5% positive. Okay, cheerful. On the business loan side, it was hard to get data. We got a lot of stuff from the Fed. Business loans, unfiltered, generated default rates of somewhere between 8 and 11.5%. So that gives you some comfort, I think, on the 13. Nothing's perfect and nothing's guaranteed. Maybe the next recession will be worse. But people say to me, Alan, you know, business climate may be getting worse. And that's why I say this space is truly compelling. I don't know, can you find risk attributes like this in some of the other stuff? I think it's hard. All right. Here's the portfolio, this model portfolio we created. An 8.7% yield, leverage of 7.4, duration of 19 months, collateral of those that have, where it's a realistic measure, which is some of the managers, 52%, quarterly liquidity after a 1-year lockup, correlation almost nothing, average manager life was 6.7 years. Kind of attractive, I think. All right. Had to make some generic assumptions. I assumed the cost of putting this together, if you delegate it to somebody else, is about 2%. You can probably do better, which would increase the yield. And you're having liquidity that matches the underlying allocations. Big issue came up about liquidity. All right, being an ex-insurance guy, I said, well, is it real? Guy said, well, you know, you don't want mismatch, blah, blah, blah. Certainly on the direct lending space, he's right. This stuff is all shorter duration. So here's what we did. We took each of the underlying allocations and said, what happens in this mythical fund, every investor liquidated simultaneously, and every investor in the underlying strategies and managers liquidated at the same time? How long would it take to get your money back, including notification periods, that was alluded to, audit holdbacks, and gates? A number of these funds that we put in this theoretical portfolio have gates. The answer, which sort of reflects the 20-month duration, is 3.5 years. What do you think? Not too bad. All right. Got to talk about risks. Some of this didn't come up, and I don't want to shock anybody, but I want to give you some risks. Anybody here play on consumer lending platforms? Think Prosper Lending Club. Anybody have investments? Okay, a few brave souls raise their hand. Oh, there's a few more. Come on, don't be shy. All right. There's a case called the Midland case. Anybody ever heard about it? Few hands. Midland, on the consumer lending space, is basically asserting that as the consumer lending platforms use a bank, typically WebBank in Utah, to get around the usury rates. Sort of amazing that you can use a bank to do that. In the Second Circuit Court of Appeals, they said, not real. They're not holding the loans long enough to really be in the chain of ownership. They're just passing it through. So the Second Circuit Court of Appeals said no. Think Connecticut, New York, and Vermont said, we don't think that gets you out of usury limits. Okay, so those loans had to be reset at a lower rate, and that case is being appealed to the Supreme Court. Who knows what's going to happen? If you talk to Lending Club, I just talked to the guys at Prosper last week, they think there are some good solutions from that issue, but there is regulatory risk. What do I think will happen, having played a little bit in other times in my career? I think the bank may have to hold the loans longer. That's one possible solution. What do I think that'll do? That'd lower the yield by maybe 50 bips. Okay, throw in some other regulatory risks. I can think of others. The Consumer Financial Protection Bureau is looking at the consumer lenders particularly hard, saying, hey, you guys got to have more disclosure. Maybe that adds another 100 basis points of costs. The yields are still so high, I don't think that's the death knell. All right, so that's a risk, a regulatory or political risk. Economic crisis was touched on, not really too specifically. What will happen to some of the loans? A maturity extension, right? There won't be as many prepayments, and maybe some of the payments will be delayed. I don't think it's a crisis because there'll be less liquidity, but geez, you got such short duration as a starting point, certainly versus any other alternative. You will have borrower failures and asset depreciation. Okay, higher write-offs. I talked about, we had that 8-to-1 deal. Slower and smaller recoveries. We didn't get a chance to nail down, you'll have to ask them later, some of the managers. It's not just default rate, what's the recovery rate against a default? Okay, the loan defaults, how much do they ultimately get back? But you got a significant rate buffer. In this portfolio, this theoretical portfolio, hey, not bad, 0.02% is the average position size. One of the lenders has, in the small business side, the largest loan in the portfolio is 1.62% of the entire portfolio. Again, you're talking widespread diversification. With anything, you've got always the risk of individual manager failure, with return reduction, okay, but if you've got multi-managers, maybe it's not a crisis. Increased competition. I talked about the 1% share that the consumer lending platforms have. The business lending guys talked about it a little bit opaquely. They have even less share of the total marketplace. Regulatory. On the life settlement space, that space has already been re-regulated. Now here's, a number of you raised your hands. Let's bite into the big issue on life settlements. People say, oh my God, Alan, how do I deal with life settlements? Oh gosh, I'm betting on deaths. Oh, it's just so sleazy. Here's the interesting thing though. The regulators, insurance is a state-regulated business. The regulators have said in 42 states, it is a crime if you do not tell a policyholder that's thinking about surrendering their policy, lapsing it, or of course the insurance agent wants to rewrite it, right, at a lower face amount. It's a crime if you don't tell that insured and that policy owner that there is an alternative, which is to sell it to an investor. So clearly, I believe the regulators have picked up on the social benefit of saying to an older policyholder, hey, you need some cash? We should make it as easy as possible for you to get the most cash. You won't get it from the insurance company. That, having been there, I will tell you, will not happen in general. So that's what I would say the regulatory issues are. I have 18 seconds almost. All right, I started with these. What do you think? Did I win over? I don't know where Ken is, if he's still here, but compelling yield, 8 to 10%. Protection from the unexpected. Rising rates, 20-month duration, you got it pretty well covered. Shock defaults, they can go up 800% in this portfolio. Not bad. certainly withstands the test of recent times, 08, 09, which people have called the Great Recession. Low correlation to equities and interest rates, pretty amazing. It is truly a portfolio complement. I talked about what are the alternatives. Where else can you go? And by the way, if you have great ideas, I am shameless and I am an allocator, please tell me. I welcome the input. Cash income. It's great. You can get it as you go. Even that first year, most of the players will let you take out the cash income if you want it. It's a hard lock for the first year. This isn't a piggy bank. So there you have it. That's why I'm a bigot about the space. I hope I convinced some of you where your fannies are getting sore from sitting on the fence. One last thing, just for fun, before we all go drink. You talk about skepticism, right? Here's a cute story. Sherlock Holmes, we all remember him, is talking to Watson, and they decide they're going to go camping one night because Sherlock Holmes wants to torture Watson a little bit. So they go camping, they get all their gear out of the car, they're setting it up, and Sherlock Holmes, being the questioning guy that he is, they're settling down to go to sleep. And Sherlock says to Watson, he says, Watson, what do you see? Do you tell me what's going on here? Watson, being the pedant that he is, says, well, horologically, Sherlock, it's 9 o'clock at night. Sherlock's getting a little restless. Watson then says, Sherlock, meteorology, it's a clear night. And astronomically, I can see the Big Dipper. By this time, Sherlock Holmes can't stand it any longer. He says, but Watson, you're missing the key point. Somebody stole our tent. Anyway, thank you very much.